Hey, my name is John Stevenson, and welcome to the Guaranteed Retirement Guy Show. Today, we're going to be talking about the best ways to use annuities for long-term care costs. So I've created other videos about this in the past for long-term care policies, but this one is strictly going to be talking about how to use annuity contracts to fill this long-term care need. Because sometimes people are too unhealthy to purchase a long-term care policy in the first place. And if that's the case for you, then annuities probably are the best option for you. And there are ones that will give you enhanced payout if you need long-term care as well. So it can be very, very good. There's also one particular one that I did cover in one of my other videos that I'm going to touch on at the end of this video. That is a true long-term care policy. You can buy it with non-qualified funds, and it is all tax-free. All the benefits are tax-free. And so it just depends on your particular situation, but you can do both. There are different ways to do this. And in my opinion, annuities can be used for a lot of different things, especially if you've got a spouse and they die and you need to replace some of that Social Security income. That's a great way to do that as well. So I'm going to share my screen and kind of show this, how this would work for you. And then you can kind of, if you want to go to my website, johnstevenson.com, you can play with the numbers yourself. I got calculators on there. Usually if you're looking for something that's more flexible where you can activate it at any time, use the income rider because that one is probably going to give you the highest payout as well. So do that. And if you want to book a call and talk about annuities for yourself, we can do that. So again, there's also a link below this video that you can go directly to my calendar and we can get on a Zoom call that way as well. Okay, so this one is a client who is 61 and they've got $100,000. They're in Colorado. And if you got 200 grand in, it's just going to be double. It's going to be double these numbers. So use the 100,000 and you can easily replicate whatever it is in your situation. If you got $1 million, then just multiply this benefit by 10. Okay. So, and in this case, they're saying, well, since we want this for long-term care, most of us, if we do need long-term care, it's going to be in our 80s, sometimes late 80s. So because of that, you can see, like, if I were to scroll this down, 100,000, it'll give me $11,000 a year guaranteed income. That's great. But I'm not using this for this. I'm trying to figure out the best annuity strategy for creating long-term care income in case I need it. So, and if you don't need it later for long-term care, you can just activate it whenever you want and take income, for whatever reason. So, all right. So I'm going to pull this out here and I'm going to say 87. Okay. 87 years old. So same 100,000. Okay, you just let it sit there and grow. And if you want to activate income on it earlier, you can. If you want to take your cash out, you can. It's your money. You're just leveraging it for a much higher payout later on if you leave it there. All right, so 87 years old. The payout's pretty good. So we've got American Equity that pays $32,000 out guaranteed. And then you've got Athene that pays it out guaranteed. Now, these are the payouts if you don't need long-term care. The long-term care is more. So if we look here and say, well, let's say I don't activate this unless I need long-term care. Otherwise, if you just activate this and you just need guaranteed income, they'll give you 32 grand a year. That's great. It'll still give you long-term care later on if there's cash value in there. So that's what you have to think about. So let me show you the illustration. They're going to show you worst and probably what it will do. Okay. So worst case is guaranteed and hypothetical is probably what it will do. So we'll look at this and we'll say guaranteed values. Worst case scenario is the income rider is going to eat up your account value because you got the fees coming out. But again, you're doing this for income and long-term care, so it doesn't really matter. But if you go down here, the account balance is going to run out. By the time you reach 87, it's going to be down to like 27 grand. But your income, that's guaranteed for life, okay? And that's 32,365. So again, this is worst case. Worst case scenario is you don't have any growth. And if you don't have any growth, then you are stuck with 32,365 for the rest of your life. That is what you'll have. Okay. If you take that out for 10 years, you're taking out $320,000. Okay. It's that simple. Now you'll notice over here, you see the enhanced lifetime withdrawal column. You see over here, it's like 64,000. In my opinion, you're better off taking it early because look, the income here at age 80 is the same as it would be at 86, 87. So you see what I mean? So you could take it earlier. And if you take it earlier, you notice, let's say you need long-term care earlier, like at age 80, your benefit's going to be doubled to $64,000. So long-term care benefit is basically if you cannot do 2 out of the 6 daily living activities, that's when they will accelerate more income to you. And they will basically deplete your account faster And then what will happen is once it gets to 0, it's just going to revert right back to the 32,365. All right, so that's the guaranteed side. Let's look at the hypothetical. Hypothetical is just showing the exact same income. Okay, there's nothing different about that. The only difference is you've got some decent growth, which is probably more likely. So if you look at that, then if you activate this at 87 and you need long-term care right then it's going to be 64,000, and you can see it's going to last for 3 years. Okay, maybe it'll last longer. Maybe you'll get more growth in here. Okay, but it's going to last for a few years, and then after you have exhausted the account down to 0, then they're going to give you 32,365 for the rest of your life. Okay, so that's a great way to do it. There are other policies out there maybe that have more growth. Let's look at Athene. Athene's a great company too. All right, so Athene, if we look at growth, yeah, you know what? If I was to pick either one of these, I'd say Athene, because look at this. They give you more of the S&P index than the American Equity does. And because of that, your account balance lasts longer, which means if you need long-term care, you're more than likely going to be able to use it for the entire 5 years. That's great. So you're going to be able to use a lot more of that. So you've taken out over 5 years, $64,000 a year. That's really good. You're taking out over $300 and something $1,000 for your long-term care needs. And then after that, it reverts back to the 32,360. So pretty good. So that's what I would recommend if you're looking for an annuity strategy to help you with your long-term care needs. That's what you would do. And you might be thinking, well, that's not enough, John. Well, then you just need to put more premium in. Maybe 100,000 is not enough. Maybe you need to put 300 grand in. Okay, 300 grand, you already know is going to give you $96,000 a year. Okay, and then you'll double that if you need that. So if we go in here and say, well, we want to put 300 grand in, and I'm going to show you the other one, the pure LTC benefit right after this. All right, so 96,960 with Athene. So I'm going to go over here and take a look at this here. It's guaranteed for life. So if you happen not to need long-term care, you could always just turn on the income. You can see here, if you turn on earlier years, what you'll get forever. So, but if you need long-term care, and again, this is showing the guaranteed side, worst case scenario, if the index doesn't earn anything. But if we go at what it should earn, again, if you need long-term care at age 87, you're getting almost $194,000 a year for 5 years. Okay, at the end of that, reverse right back down to the 96,960 for the rest of your life. So anyways, really good numbers. This is really important to see. So if you want more of an absolute, you want tax-free income, then what you'd want to do, and I'll just kind of show you here. I want you to see what this looks like. All right, so 65 years old, claim age 87. I'm not going to change anything else. Same 100 grand. Right here, monthly benefit 7801, guaranteed. Okay, and that is guaranteed for 5 years. That is a pure LTC policy. So that's an annuity policy, but it is just for LTC. It is not for income outside of that. Okay, so if you just want to you want to use it for income later on, and you don't have, you're not qualified as far as LTC. You can't do 2 out of this. You can do all daily living activities, or you can do 5 of them. Then you're not going to be able to get this. If you can cancel it and get your money back, that's fine, and all the earnings. And if you die, it'll go to your beneficiaries. But this is a pure LTC policy. Okay, that's what this is for. So, and if you decide, and you're not deciding at age 87 to take it. This is just illustrating. If it is at age 87, that's what it'll be. Let's see, what is it, 90? So 90, yeah, it's still the same. So let's see what it is at 82. A little bit less, not much though. It's pretty good monthly benefit, and that's tax-free. So you got to buy it with non-qualified dollars. So it can't be IRA, can't be 401k money. It's got to be money from your bank, or it's got to be money from your brokerage account. It's got to be money that's already been taxed. Okay, that's how it works. So anyways, I hope this helps. I really just want you to be able to see what's available. If you want to book a call, there's a link below this video. You can go to my website, johnstevenson.com, search annuities on my annuity calculators, and you can book a call there. So if you like this, I hope you like, subscribe, share, comment below, and we'll see you in the next video.